Welcome back. We're going to continue with our lecture, and what we're going to do in this uh, section is talk about our accounting, some of our accounting principles and how they relate to practice. We're going to talk about the basic accounting equation, the expanded accounting equation, and then we're going to take a look at a couple of accounting transactions so we can get busy about doing this work of accountants. The first concept that we're going to talk about is called the business entity concept, and under the business entity concept we keep the activities of the owners, creditors, and other businesses separate from our business records. In other words, if I start a business, uh, and I have a business, Michael Whitehurst CPA, I keep those transactions separate from all my personal transactions. If I want to take money out of my business, I do what's called a draw, and I take that money, put it in my personal checking account, and I pay all my personal bills from there. So I keep my business life separate from my personal life. And we always want to do that. The next concept we're going to talk about is not really a concept, but it's the different forms that a business can take. And there's actually four different forms of a business. We have a proprietorship, and it's the simplest. There's one individual. Uh, if you have if a husband and wife are owners, they would be considered actually a partnership. So you only can have one individual, and normally it's if it's a husband and wife, it's either the husband or the wife, depending on who's running the business. But if you have two or more owners, you can have a partnership, or you can have one of these other entities. But two owners has to be something other than a proprietorship. So two individuals that go into business together can form a partnership. I will tell you that partnerships are a very risky business. You should never enter a partnership with a friend or family member, and you should always go to a lawyer. Let them explain to you exactly what you're getting into, because there's been a lot of people burned in partnerships, and it just can cause some real problems. Corporation has to be organized under the state and federal statutes, and it's the first one of these entities that's a separate taxable entity. It's a separate legal and taxable entity. And then we have limited liability companies, and it gets the advantage of a corporation and some of the attributes of a partnership. The big difference between the limited liability company and a partnership is the limited liability company does have limited liability, whereas you don't have that in a partnership. And and it got a lot more flexibility. The next concept we're going to talk about is the cost concept. And the cost concept means that we put things on the books at their historical cost, or what we actually paid for them. If I bought a building for $100,000, that would stay on the books at $100,000. If 5 years from now it's worth $150,000, I would still keep it on the books at $100,000. We don't recognize a gain on anything until that is sold and that gain is realized. The next concept we're going to talk about is objectivity concept. The objectivity concept means we need objective evidence. In other words, I need an invoice for things that I purchase. I need invoices for the things I sell. We need some kind of documentation, objective documentation for everything that goes on in the business. The next concept we're going to talk about is units of measure. And we're in the United States, so everything we're going to do here would be recorded in U.S. dollars. If I was in Canada, I'd record everything in Canadian dollars. If I was running a business in one of our European countries, I'd do it either in that country's currency or in euros. Okay, and those are some of the accounting concepts that we need to know and always be aware of, and make sure we apply those in our accounting practices. The next thing we're going to talk about is the accounting equation, and how each one of those elements of the accounting equation relates to a business. Our basic accounting equation is assets equal liabilities plus owner's equity. Assets are anything of value. Furniture, that's an asset, right? Cash is an asset. We can have intangible assets, things that we can't touch. Might be a franchise fee that we've had to pay, but that's an asset of the business. Liabilities, I think we all understand liabilities. That's the rights of a creditor against the business, or in our personal situation, or against us personally. And then owner's equity is the difference between the assets and the liabilities. That's our owner's equity. So owner's equity is equal to assets minus liabilities. Liabilities is equal assets minus owner's equity. And so I think we've got here all three of those defined. Now this is the basic accounting equation. The expanding accounting equation actually takes the owner's equity account and breaks it into some smaller accounts. So the expanded accounting equation is assets equal liabilities plus capital, that's the owner's capital account, minus drawing, which is monies that the owner draws out of the business for personal uses, plus revenue, and revenue is monies that the business takes in for sale of products or services. And then expenses, and expenses are items that's necessary to run the business, and those are subtracted. So our expanded equation is assets equal liabilities plus our capital account minus our drawing account plus our revenue account, and then minus each one of our expense accounts. Okay, so now that we have the accounting equation, let's talk a little bit about business transactions. And the first thing we need to do is define what a business transaction is. A business transaction is an economic event or condition that directly changes the entity's financial condition or its results of operation. So any economic events, so money's got to be involved for it to be a business transaction, as far as we're concerned as accountants anyway. The first thing, we're going to take a look at our first business transaction. And the first thing that normally happens in a business is somebody comes up with an idea to start a business. And in this case, Chris Clark decided to open up a business called Net Solutions. And Chris has taken $25,000 out of his personal bank account, and he's gone down and opened a business account for $25,000. And that's because of that business entity concept. He's got to keep these transactions separate from his individual. So now he's got a company named named Net Solutions. And to record this in the accounting equation, we have two accounts involved. We have the cash account and the owner's equity account. The owner's contributions to the business are called the owner's name plus comma and then capital. So in this case, we have on assets on the left-hand side, cash in the bank, $25,000. And since there's no liabilities at this point, that equals our owner's equity, which is Chris Clark Capital, $25,000. $25,000 on the left, $25,000 on the right. We're in balance, we're good, and we're ready to take a look at the next transaction. The next transaction is the business, Net Solutions, decided to purchase a piece of land as a future building site. So Net Solutions paid $20,000 for a piece of land. And in this transaction, we're actually staying on the left-hand side of the equation. We're only affecting our asset accounts. We're swapping one asset for another asset. Swapping cash for a piece of land, which is another asset. And so we're swapping $20,000 worth of cash for $20,000 worth of land. So now we have $5,000 in cash, and we have a piece of land, $20,000. Add those two together, we got $25,000. Chris Clark Capital on the right-hand side, $25,000. So our right side and it is equal to our left side. We're in balance and ready to take a look at another transaction. But at this point, we're going to stop, and I'll pick up in the next section, and we'll take a look at the rest of our transactions that we're going to look at.